Advisors. We are a nationwide tax and asset protection firm, which does a couple of things, especially from our higher net worth clients' perspective, is a lot of times, depending where you're located, you're not going to want to invest in the state you live in. So it's nice to work with a nationwide firm that can help in helping navigate the waters of all the different little state laws that are out there. As Amir said, we sort of have seen everything or have gone through everything and looked at things in the past. Such many of you, I know doctors tend to be pretty good, I guess, consumers of things like bridge trusts and family limited partnerships and items like that. We steer away from that area just because it's tends to be a lot of times like bringing a bazooka to kill a fly at a lot of points in view. But certainly for one of the things I know we focus on with our doctor clients is we put a premium on the anonymity, right? I mean, as medical professionals, as doctors, as any type of professional, most plaintiffs' attorneys know there's some large insurance policy out there. However, we don't want them to see anything outside of that insurance policy because now they think they can get limits plus. So there's some different things from the strategy perspective we look at for professionals or high net worth clients. But the basics are all still the same. We want to make sure you're not overpaying in taxes where we can help you. We want to make sure that if you're a high W-2 income earner, we're doing the right amount of tax planning for you to drive that down. However, we want to also keep in mind that you're not, we don't want to drive it so low, you can no longer get financing for the things you want. That's one thing you'll come across, especially with tax advisors, is there's sort of gurus out there who'll say, we'll get your taxable income down to zero. It's like, that's great and all, but if I'm trying to purchase something or need to use credit, it's going to be pretty hard to acquire things if I'm showing $0 in income. So it's one of those things we look at, like I mentioned, and you've probably seen on the video. Number one is we want to make sure you're protected from a liability standpoint on your investments. We don't want you to be in a scenario where it's, something happens and you lose everything. The second piece is we want to make sure you're, from a tax scenario, you're doing things in a tax-wise or tax-efficient manner so that you're not paying more than your fair share. And then the third side is we also want to make sure from the business side, you're in the best position you can be in order to fulfill whatever goals you have, whether that's, you want to make a bunch of money stock trading, you want to do a bunch of purchases and investing in real estate. My experiences with high net worth clients, they sort of want to do everything. So we look at that picture on the everything you want to do. I guess that as well as another piece when we start talking about real estate in a market where there's some concerns about inflation. Real estate is actually usually a great investment because you take advantage of that inflation as your equity increases in the property. So that's something I guess that's come up even today when I taught one of our classes. The stock market, volatility, right? There's some pieces where you can look there too. So that being said, yes, work with a bunch of clients from all 50 states. Usually on an average week, I'm probably dealing with clients in excess of, somewhere in the $100 million range. So it's, that being said though, too, there's clients that I started with that started with absolutely nothing. So we work with a full range of investors, whether you're just starting out, whether you're very experienced. We have like Henry Ford said, we make a seat for every butt. So we're happy to help on that side too. Going along with that, Amir also mentioned as well, we actually have different levels of service for what we do. So if you're somebody who's a more experienced investor and has a lot of maybe different single family properties or a lot of different properties, we have services all the way from unlimited business entities for life until all the way down to a la carte. So no matter what I talk about or what we say or how sort of deep we get into something, just realize there is a level for everybody, no matter where you're starting or where you're at. So I just want to make that clear too. Looks like we got our first question here. Thanks for sharing information and opportunity to ask questions. Of course, does income share from a K1 of an S Corp taxes at 37% tax rate? No. So not unless you're already in that tax rate. The way the tax rates work is it's like a ladder. So the first X amount of dollars is the lowest rate, so on and so forth as you're climbing. So income from K1s could technically be at, I think it's actually, what is it, 36.9%, but same thing. But it'll just depend if you're at that tax rate when you receive that K1. Is it added to personal income for taxes? Yes. Yep, your K1 is added to personal income for taxes. One difference you may see, it says S Corp, so I'm assuming an active business here. Sometimes or on syndications, the K1 piece can act a little bit different because it's a investment property or investment income.
Carl, I got a question. So with, I know some medical groups are set up as a LLP, and then each individual physician or professional is an S Corp, and they pay themselves a W-2 and a K1. Isn't that mainly just to save like Medicare, Medicaid taxes on the K1 portion? And yes. Is there any extra financial benefit with that setup other than saving that, 2-3% Medicare, Medicaid?
Yeah, that's basically it. So what you're doing is in an S corporation for any service-based business. So even if my own practice, I would probably set it up as an LLC, taxed as an S corporation. If I was doing that, it would be because I know I'm going to be required to pay myself a reasonable salary. So that salary would be paid out at my tax rate plus the 15.3% for the, FICA, medical, all those other good little pieces. The other 2/3 of income I would take as a distribution, which does not get tagged with that 15.3%. So that's the reason you do it. So you don't have to take out the entire thing or get paid as an employee where you're paying the 15.3% on the entire amount of the income. So it's where a lot of sole proprietors really get hammered because they think they're somehow just, it's the same thing as being an employee. And really they would be exponentially better through an S corporation. So great. Let's see.
So we got some real estate investors asking some questions here. Looks like, what's the next one here? Do you have any advice?
You want to ask them and I'll answer?
Oh, well, sure. It looks like the next question is, do you have any advice for a first-time investor in active real estate? And that could be a whole other topic in itself, but
the biggest thing for first-time investors, and Amir, you can agree or disagree here too. I probably did a lot of the same stuff you're doing out there. Don't get paralysis by analysis. If you ran the numbers, you did a reasonable level of due diligence, get into it. You'll be happier that you got into it rather than waiting to find, that ultimate perfect deal that may never come. Real estate has a really good way of, given enough time, making everybody look like a genius.
I think there's been a little bit about a buzz about, if people are married, having maybe the significant other becoming a real estate professional or getting that status, because then those passive losses, you could take it against your active earned income. Can you talk a little bit about that? And then I'm going to share a personal story where I spent $300,000 trying to defend my real estate professional status. And I'll tell you how that went when I went to appeals, but I'll let you go first.
Yes. One of the more controversial pieces of that test is it has to be your primary use of your personal services. So, folks like, doctors, lawyers, things like that, it's going to be pretty hard for that person to claim that real estate professional status. So you usually look to the spouse if they're not also sort of using their profession or their service time somewhere else to be able to claim that. And then if you're married filing jointly, you sort of get the best of both worlds, right? High W-2 income on one side of the marriage. On the other side, your spouse is able to claim real estate professional status. So the deductions, depreciation, things like that would normally be trapped only or able to be used against only things like your passive gain can now be elected to be treated as active and taken against your active gain, which would be like your W-2 income.
Right. And just quickly, a little story about me. So I'm single. I don't have a significant other, and I have a
considering it now.
But I'm a realtor in my own brokerage, I am active. I'm putting in, I'm definitely putting in the hours. Okay. And then, but somehow an audit was triggered because there was actually some fraud at H&R Block before I knew about Anderson Advisors
Mhm.
getting like real
Yep.
CPA. So somebody basically fraudulently filed a 1099 for exactly $100,000, and that $27,000 refund check went somewhere else, not my bank
Oh,
account. That triggered an audit. That, oh, look at this anesthesiologist trying to claim he's a full-time real estate professional. This is back in like 2013, like 7, 8 years ago. So for 4 years, they kept on auditing me and just taking away all these deductions. A little bit more than 300 grand in deductions. I was doing all kinds of accelerated depreciation and stuff like that. So at the end of the day, I knew I was in the right, but it did cost almost exactly 300,000 to fight it and then beat them in appeals. Now they leave me alone. But if you have a significant other, it's better to do that. If not, make sure that you have all your books ready. Hey, what you actually did, you showed this home, how many hours a week you work as a real estate professional, because I didn't do a good job keeping track of all that. So if you guys are doing that in the real estate world, just get some type of app to track your miles and where you go. So that's just a little advice, in case you get audited, which the chance I know is low, is probably like 1 or 2%. But when it happens, it really sucks.
and it's even lower when you're using things like corporations. I
Yes.
mean, I think the last time I looked at the C corporation from the last, I think the last technical, I forget the name of the book. It's like their field audit techniques and statistics book. And it was like 0.3 or 0.03% of all corporations get audited. So you're 100% correct. It's one of those things. You're doing it. It's like walking through a minefield when it comes to taxes. You don't need to know where every mine is, as long as you know where to step where they're not. So the easiest way to do it as a professional is to have your spouse qualify, just because the assumption is there, if you're a professional, that you couldn't possibly be spending more time as a real estate professional than your given profession. So
Right.
that's a high percentage win on the IRS side. Like you said, the way to combat that is great books and records. However, be aware, I think that if memory serves, 750 hours is sort of what you need to prove.
Yeah.
And you don't want to stop at 751. You really want to have a surplus there, because they're going to sort of try to tick off, a couple hours here and there until all of a sudden you're under that limit, and then it's decisive. But like I said, if you're sort of using the analogy of a minefield, long term, it's really about knowing what things make you a high audit risk, what things don't, and then taking advantage of those things that don't. So it's real estate investor. There's in the tax code, there is a ton of things where the IRS gives you a huge benefit. Stock, same. There's some similar, but not exactly. Just that for most of your stock investments, you're not going to have self-employment tax. So it functions a little bit like passive income, but not exactly. So lots of cool little techniques there. When I just, and I said this in the video too, when I discuss it, I look at it as two separate things. Taxes, I know I'm going to have to deal with every year, so I need to plan for them. Liability events, I know it's likely one will happen at some point, so I need to plan not to get wiped back to zero. Because I have met with those folks who've been doing investments, work their entire life, have a small portfolio together. Something unpredictable happens on a property, and it's sort of like the game of chutes and ladders. You take a big chute down to the bottom, and when you're 60, 70 years old, there's not a whole lot of time, or you don't have the energy to put it back in there. So you might as well protect it, because ultimately we're all building for a reason as well. And most of that for us is to pass it on to the next generation or family, to sort of give other folks a step up as well. So we want to make sure we're protecting that for the future.
Yeah. And so for some of you guys that just joined, we have about almost 30 people in here now, but we were just talking about advice for a first-time real estate investor. We're talking about just getting in, and how you could have your significant other possibly be a real estate professional. So those passive losses, instead of only being used for passive gains, can be used for your active gains in your primary job. We got a lot of other questions here too. Let's look at this next one here. It's like it says, hold on a second. Was that the first question? Okay, second question, third question. What ideas do you have for a W-2 doctor who has significant short-term capital gains?
So significant short-term capital gains, probably sounds like a stock trader, most likely. For a person who has a significant short-term capital gains, really is going to take some tax planning. So short-term is a little tougher because it's at your normal tax rate. Long-term is going to be at long-term capital gains rates. So I would look at, can we reinvest it? So maybe looking at something like an opportunity zone. Also, if I'm just incorrect and maybe you're just, I don't know, bought some property turned or something like that, we can look at that scenario too. But really anything when we start talking about how do I lower my taxable income, it's tax planning. I mean, everybody sort of likes the idea of doing taxes and getting information on it. The downside is that doesn't happen when you submit your shoebox full of receipts. It actually has to be done throughout the years. We put in tangible goals and things to do to drop down your taxable income. For a lot of professionals, a lot of high W-2 individuals, a lot of times practicing or purchasing properties or investing is actually for the purpose of dropping down their taxable income. It's actually not creating an additional income stream, but you sort of hit a ledge where it's like, no, I need to keep buying so I can keep my, excuse me, my taxable income, excuse me, lower. So it's an interesting sort of dynamic, especially as your investments grow.
Yeah. I'll agree with Carl. And disclaimer, I'm not a CPA or accountant or advisor or anything. I just share my opinions. But at the end of the day, I think the game is look at what you're doing. How is the money coming in? How to structure it into different buckets that are more tax advantageous for you. And at the end of the day, you're probably going to pay something, and that's okay. Yeah. That's okay to pay something, but we're just trying to minimize it. Now, having said that, another thing, I don't know if this is where you're going with that question we asked about the W-2 and short-term capital gains. I think also if somebody, this is a little bit out of the box thinking, but if you're spending a lot of money in something, let's say if this wasn't coming from stocks and you're just like making a lot of money being a doctor or something, why not, create a business around something that you are spending money in on your personal side? So I don't know, I'm not recommending this, but let's say if you bought a lot of cars, why don't you get into the car rental business, or, at least ask somebody to, be a partner in some car business. So I'm just mentioning that because I'm partners with somebody in Oklahoma and he flips cars. So, and I've gone through a lot of cars in the last 10 years. So there's some deductions there. So sometimes if you just see how the money is coming in, and if it's just hitting your income bracket, your tax bracket, then maybe think about creating an LLC. And then another thing I've done for a few people, I don't know if you guys saw my e-commerce talk, but I've created a couple Amazon stores for people. So now they actually have a business, and it's really great for the people with just straight up W-2. Now you have your own company. You could hire your significant other. You can even hire your kids. There's all types of corporate deductions you can get. Anytime you travel, you're probably looking at something you might want to sell on Amazon, maybe not. But having a business, I think, is really key to getting some good tax deductions. If you're that W-2 doctor out there that's just making money with that W-2 income. So, and Carl, you could disagree or agree with me if you want, or add something. That's just my thoughts.
No, I agree. I mean, I agree. I've actually had lots of clients over the years, especially professionals, and it's like people sort of look at this thing as they get wound up and start looking at it as the chicken and the egg agreement. Is what creates the business? Do you start the business first and then find the business, or do you have to have the business first then create the entity? And I've seen it work in both ways. It always starts with, what do you want to do? What are you passionate about? If you can answer, even sort of say, I think I like this, then I wouldn't hold off on it. I just set up a C corporation for my wife last year because she was looking to do some sort of like notary services, things like that. So Same advice I would get, is, hey, you want to do something good, let's do it the right way from the beginning though. So if we need to buy, computers or some sort of,
Exactly.
something connected to the business, let's take that out of our taxable income to be able to do that. Like, yes, I know I'm going to have to front the cash up front, but I can log it as a reimbursement, and as income starts flowing in, great, then I reimburse myself, and now I don't have to pay taxes on the income to get reimbursed for that expense. So
Looks like my buddy Jay is on here. He's asking a question, which
sure.
you might have partly answered it. Thanks for being here. W-2 employee. Wife just went from W-2 to K-1. I invest in stocks, have a brokerage account. This is a broad question, but how should I think about and approach taxes and tax planning? So I think we talked about that a little bit. Did you want to add anything?
Yeah, just a reiteration of it. Tax preparation is sort of on the value meter, is kind of here. It's really filling in boxes. Tax preparation, you're sort of in this range. So, or excuse me, tax planning, you're sort of in the larger range. So tax prep, sort of low value. Amir, you're talking about H&R Block. The government actually audited some of the chain preparers, and for business tax returns, they actually got a whopping 0% accuracy rating.
Wow.
So it's one of those things. And then the mom and pop shops did a little bit better, sort of these local tax firms, and they were in about the 3% range. So it's one of those things. It's a interesting piece of what happens, but a lot of those tax prep places, especially when it comes to business return, where you get the biggest return for the sort of money and effort you put into your investments in daily life, you work with somebody who does what you do. So
right.
We do thousands of business tax returns a year, especially focused on real estate investing and stock trading. So it's not coincidental. That's who our clients are. And
right.
So if you work with Anderson, you're working with a firm that's doing that type of business on a daily basis. Also, the partners of Anderson, Clint Coons, Toby Mathis, Michael Bowman, and I'm not a partner yet, but myself as well, real estate investors, stock traders. I invest in cryptocurrency. We make it our business to do the same type of business you do, because quite frankly, that's what interests us and what we want to do, have the most knowledge on. So same thing y'all are doing, right? As soon as you started looking at real estate, or as soon as you started looking at stocks, my guess is a lot of you, because I think we're all pretty much like-minded professionals, probably dove in until you were drowning in so much information you didn't know what kind of decision to make. But that's the same thing with us. We invest, we learn, and we excel.
Yeah.
So.
Well, it's like the next question is from a current client of Anderson Advisors. We got Ash Reddy here asking about how, okay, let me just read the question. I have a holding LLC for my passive syndications taxed as a partnership. What expenses can I deduct? Home office, education events like this one? By the way, I'm pretty sure you can deduct this thing. So if you need a receipt or something, just let me know. So, so what do you think about that, Carl?
So Ash, I would have to leave that to your tax preparer on where they want to claim those deductions. My opinion, or what I see the most frequently, is going to be if you have an entity with some sort of corporate taxation. That entity is what carries the lion's share of where we're going to claim deductions and expenses. Now, the thing that'll also differentiate that is some expenses, deductions are better on the personal level, some are better on the business level. Most people at this point still fall into the standard deduction since the Tax Cut and Jobs Act. So unless you're outside of that standardized deduction from an individual level, there's not a ton you're doing with your individual tax return. Now, what we like is that the individual tax code is earn, pay your taxes, government lets you spend what's left over. The corporate tax code is earn, spend, and then pay taxes on what's left over. So we try to spend down that bucket the best we can in the corporate side. And that interplay between the two is where sort of the music is made, if you will. So can these things be deducted? Yes. Where? I would have to leave that to your tax. If you're using us for tax, leave it with your Anderson tax preparer, and they'll find a good place to have it. The home office, by the way, those of you who may be taking the home office deduction as an individual, audit flag. It's just abused too much. What we tend to do is through your corporate entity, reimburse you for the use of your home office and treat it as administrative office. So you can now also track mileage from your home to wherever you're doing business and reimburse the mileage for that as well. So just as the home office thing made me flag there because I talked a little bit about this morning in the class I was teaching this morning, but we do it as a reimbursement, and the reimbursement is actually even better because you can take just ballpark 20% of all of your household expenses as a reimbursement from your corporation. So that includes HOA fees, your utilities, all sorts of things. So just a good piece to note there as well.
Cool,
And I
cool.
actually have a direct message here. So I won't read the person's name, but I'll read the message. Any thoughts on the conservation easement deduction? Is that a strategy dead due to the increased IRS audits? John, it's not dead. We've used it for a few clients. What I will say is it is very narrow. So it's sort of like it's not, I guess it's probably a little bit narrower even than the opportunity zones or opportunity funds. But it's one of those things where you basically get a checklist and you got to check every box for it to make sense, or it just becomes sort of untenable. So I would say it's not dead, but we would have to look at it at a very individualized level to make sure it made sense for you. We all want our own Mar-a-Lago though, so I can understand.
Cool, cool. You got another question here from Alina. Is there an income limit for claiming passive losses from real estate?
That's a good question. I'm trying to remember. So off the top of my head, I don't think there is an income limit for claiming passive losses currently from real estate. So just so everybody knows too, I am an attorney. I'm not a CPA. So I know a lot about the tax side, but I pay somebody else to do my taxes. So some of those granular details I would actually have to look up. So I don't think so, but I would have to take a second look at it.
And Carl, back to the land conservation easement, I was really going to have somebody speak about this at the conference, but I talked to one of my buddies. He's a big time IRS attorney. He used to work with the IRS. Now he helps people like us. But
Yeah.
he was saying, you know, that it's so hot right now. Like I probably shouldn't touch it. He's pretty conservative. That's why I didn't want to bring it up and educate people on that, and then they go down that rabbit hole and get burned. But I bet that there are a lot of people saving some money using, I mean, the chance of getting audited, I mean, it depends on how they're running it. This is my opinion, by the way, so everybody can disagree or agree, but I know people that are running it pretty legit and not blowing up the values to crazy astronomical levels. And they've been doing it for a while and everything's been fine. But, you know, I didn't bring up conservation land easement, and just a little background on what that is. Some of y'all might not know what that is, and that's might be a good thing. But basically, you know, there are people out there that are syndicating for a piece of land. And let's say it's $1 million, but it could be, if you actually built a skyscraper on it, it could be worth $8 million, $10 million. So the actual use of the land, the best use would make it like an $8 million thing. So the government will be like, okay, well, just conserve this land and keep the trees there and the river and don't put a skyscraper on it. And we'll give you the $8 million tax deduction, but you just bought the land for $1 million. So when you do the math and you're at 37% tax bracket, that's pretty good return on your money. So that's in a nutshell what that is. So Carl, I don't know if you want to add anything to that, or if you kind of agree with what I'm saying, with that it's just too hot of a topic to really even mess with.
To me, it's one of these things with the IRS. The IRS isn't, they don't make the law. They're sort of the police arm of the Treasury. So it's, as long as there is a clear path to what is acceptable, I don't have a concern about it. But what I will say is the IRS is probably more understaffed than they have been in a very long time as well. So that would tell me, if say I was running the IRS, I would be going for high percentage wins and also high percentage payouts. So I would think they're going to be looking at very, well, I guess, companies with a ton of income. So probably your $10 million plus type companies. that probably have been playing a little fast and loose with the returns so that they can get a high percentage win and a high percentage payout. Conservation easements are certainly a flavor of the day, just because President Trump had, one of the more famous ones we got to hear about sort of every week when we heard about a report from Mar-a-Lago. So I can see why that would be a focus, just because it's sort of on everybody's radar. And before that, it really wasn't. So yeah, like I said, for me, it's all just some of these things are these things that you hear from folks that want to sort of blow everybody's mind. When you start diving in, they have to be very detailed, specific, and they have to be correct. So there's actually the ability, if you wanted to sell your personal residence to, say, an S corporation you own, and be able to rent it out and treat it like a rental property, take advantage of the capital gains exclusion. Then you can also do a 1031. I mean, you can do almost anything in that scenario, but you've got to tick about 15 different boxes for it to work. So the more boxes there are to tick, the less likely it is that everybody's going to fit into that scenario. So sort of back to the question that Jay was asking, it comes down to planning. If I can situate myself to tick all those boxes and it makes sense, great. But I've got to do the planning ahead of time. I can't come in, today when if you didn't extend your tax returns, your taxes are due today. And you come in and say, okay, I'm ready now. It's like, well, great. We've got just enough time to enter the numbers into your tax return and submit it. That's not planning time. So.
Right. All right. We got another question here from Alina. Can charity donations on K1 of shareholder be added to personal income taxes, itemized deductions?
So there is the ability for businesses to donate to charities. However, you usually get a better net effect out of it by doing it from your person. So doing it individually, you tend to see a better tax result. So I think even still during CARES, I know you could donate up to 100% of your AGI to a nonprofit. This can be a powerful tool, especially if you are in control of a nonprofit and have that sort of as part of your business plan as well. But I would just say on that one, yeah, usually it works out better if you're individually doing the donation, not having the business do the donation on your behalf.
Yep. That's a good one. Here's another message here. What are the pros and cons of using an Arizona versus Wyoming for a holding LLC for your investments?
So so between all the states, everything sort of falls on a scale. I know there's a couple of really good asset protection attorneys in Arizona. So they tend to suggest Arizona entities. My opinion is, if we're looking at sort of the hierarchy of where the best states are for asset protection, it's pretty much always Nevada and Wyoming, tied for one or two. Delaware falls in there, usually more in regards to commercial lending and things like that, or if you have a company that's planning to go public. Arizona falls somewhere underneath. So I guess the question would be, are you okay with, somewhere in the 5 to 10 range out of 50, so top 10%, or do you want the sort of number one? And from an expense standpoint, it's cheaper in Wyoming too. So like I said, I've talked to a lot of great asset protection attorneys, or a few great asset protection attorneys, especially ones that have been around for a really long time in Arizona. I haven't seen enough that would tell me Arizona beats out Wyoming or Nevada, though.
Got it. All right, we got a real estate question here from Jennifer. I live in New Jersey and I own a short-term vacation rental property, so yay for that, in New York State. She made $13,000 in rental income last year, but putting on a new roof, which is about $10K plus some other expenses, basically no income from the property to declare. Do I still need to file a New York State return?
Yes. Yep. Unless there's something specific, I don't remember New York off the top of my head, that says you don't. Even if it's a informational return, I would still file that return.
I think it's kind of like sales tax and franchise tax. Even if there's really no activity going on or no sales, you still have the obligation to report it, even though it's not going to really affect you tax wise, or even if the IRS is not going to make $1 off of you, they just want that report. I guess their little checkbox they need to tick off.
Yeah, the only other thing that may change the scenario is on some short-term rentals, depending on what your involvement is with the short-term rental, could also be subject to self-employment tax as well. So,
Okay. Here's some more LLC questions. As a follow-up, why are the ultra rich people opening holding LLC or trust in South Dakota? What's going on in South Dakota?
it's usually trusts. So I believe South Dakota is one of the states that has the ability for a trust to hold property for an unlimited amount of time. Other states have different guidelines and lengths. So we tend to use a little bit more of Nevada for trusts because it's 375 years, but they also have what's referred to as as decanting statutes, which means you can basically pour what was ever in a 375-year trust into another one to another one to another. So same net effect. If you're going to do a multi sort of generational trust type scenario, though, that takes a little bit of planning. So South Dakota is one of those places for some reason that people sort of gravitate to on that side. What I would say though is just be careful, because even if you're doing some planning in South Dakota, just be aware all of your ancillary documents, your powers of attorney, if you have HIPAA, I guess is federal, but if you have local medical releases, things like that, that would still have to be in your home state.
Got it. And before we go to the next question, we've got even more people coming in here that maybe missed the first part. So just letting you guys know, we're just going through everybody's questions. We talked about the benefits of just overall tax preparation, because whatever your situation in, it's good to just look at everything globally to make a plan and not just do everything last minute. Also, if you're part of the Wealth Strategy Summit, there's some bonuses you guys get if you set up with Anderson Advisors with their platinum and titanium plans. So they're these all-encompassing plans. You can get a bunch of questions answered for $35 a month. It's totally worth it. They've seen everything. They've done everything. 40,000 clients and counting. There's nothing that they haven't seen, and they pretty much are investing in similar things that we have. So they're actively involved in the same things that we are. So just for that, for the last about 8 or 9 people that just jumped in recently, just a little overview of what we've covered so far.
Great.
So here's let's see, another LLC question. So Vince is asking the benefit of a Series LLC in a state that doesn't recognize the Series LLC.
So Vince, what I would say is I don't really look there. I don't know of a benefit from that side. Usually I'm concerned about investing. If say I set up a Texas series and wanted to go invest in another state with that series, that is actually a cause for concern, because not all states recognize series. And even other states that do recognize series, like say Oklahoma, it's not the same. So there's a good example of, say, because Oklahoma has a series. Let's say you set up a series LLC in Oklahoma, and then you want to invest in Texas, which also has a series statute. Texas actually views that as one LLC. So they don't recognize out-of-state series. So that's troublesome from the fact that you may actually be stepping on your series protection. The way you do it is if, say, you do have some properties in a state you want to have a series in, great. And you can actually have that series own another LLC out of state. So in that same scenario, what I would suggest is if I had a Texas series LLC meant for my passive investments, and I found a place or an investment in Oklahoma, I would set up an Oklahoma LLC owned by my Texas series. So I have something in the state that's intended to do business there, but I'm still keeping my series separate from that.
Yeah, so I only have one series LLC, and it was for a real estate development company, because all of our developments are pretty much going to be in Texas and mainly the Dallas Metroplex. So that's why I thought about that too. Well, if we want to develop here or there, but it's pretty unlikely. But since I know pretty much all my business is going to be in Dallas for the most part, that's why I went ahead and did it. But other than that, I just am that's just my personal opinion. I just will just get another LLC and then keep rolling.
Well, it's
So
easier, especially nowadays. I mean, series are interesting tools. They're sort of pitched as dollar savers, but they can add some complexity on how to work with them, especially if you need to work with banks, title companies, things like that. So my experience has been that it's easier to work with single LLCs or just traditional LLCs. But as long as you go into knowing, hey, if I'm going to use a series, I'm ready to deal with a little bit of a headache until I get everybody situated, you can use them. I have clients that use both. So like I said, my preference is more the single level. But yeah, series are an option from and through a handful of different states. So let's see, I think the next one, and unfortunately, I've got another appointment I've got to hop to after this one. But do itemized deductions count 100% for New York State income tax? Alina, I would leave that to our tax department and tax preparers because they handle all the SALT or the state and local taxes. And New York, like California, is one of those weird states that all of a sudden you'll see pop up with an exemption where something doesn't count. Something that comes to mind is the PPP loans. I know California, I think, just came out with something that says they're not going to allow you to deduct certain pieces of that. So New York tends to fall in that same category. So normally I would just defer to my tax department because they deal with the state and local taxes.
pretty cool. Well, guys, I hope you liked what we've learned here. If you guys like this type of format, let me know. A lot of people have been messaging me after the summit. They got questions about taxes. They got questions about crypto. They got questions about financing whole life, premium life financing. So if you guys want special question and answer sessions on that, let me know. I know that on Thursday, we are planning to work with EQRP. We'll let you know the time on that one, and we're probably gonna do one for the life insurance. If you guys want to do another round for Q&A with Carl, just let me know. Give me some feedback in the Facebook group. Message me, text me, email me, LinkedIn me, TikTok me. Just came about TikTok. I don't have a TikTok, but, but y'all can.
And I did include a link. It's basically a link for a free strategy session if anybody wants to have a more individualized plan. And like I said, at the beginning, for those of you who weren't there in the beginning, we create a plan for sort of every level. So if you're just starting, if you're experienced, if you're somewhere in the middle, we can help you out there. It's just a matter of just got to raise your hand and say, hey, I want a strategy session. So I did include that link. Anybody who's interested, more than welcome to sign up there. And one of our advisors will reach out to you and you'll get what we call a wealth planning blueprint.
Got it. I'm going to post in the Facebook group. I'll put in the Facebook group too for some of the people that didn't get to make it because of their work schedule. So, all right, awesome stuff, guys. Everybody, good questions. Carl, thanks for giving us your time today and knocking out some questions here. So, hope everybody had a good time, and we might do another one of these later on.
Yeah, just let me know. Your group's awesome. So, look forward to chatting with y'all and seeing y'all at some of our events as well. So. Thanks, everyone. And Amir, as always, appreciate it. And just let me know if you want me to come back and do some more Q&A.
All right. Sounds like a plan. See you guys later.
Thanks, everyone.
All right. Bye.